Hi friends, whenever a stock corrects by let's say 30% or 40%, I have seen many people rushing to buy that particular stock because they think it is a very good buy on dip opportunity. But please understand that every falling stock is not a buying on dip opportunity, and I see many people losing money while trying to catch a falling knife. In this video, I am going to speak about how to understand whether a stock is a falling knife stock or whether it's a good buy on dip opportunity. And for example purposes, I am going to pick 3 stocks. None of these stocks are recommendations, but I want to use some practical examples so that I can drive home some important investing principles in your mind. With that, people who don't know me, my name is Rahul Jain. I'm a full-time investor and a full-time content creator. And if you're new to my channel, watch this video for 3-4 minutes and I'm pretty sure you would love to subscribe to my channel. With that, let's get to stock number 1. Have a look at my screen, and the first stock is Hexacom Telesystems Limited, and the stock is down almost from its all-time high of 534 rupees level to right now at 340 level at the time of recording this video, which is almost a 35% drawdown. Now I really feel bad for retail people who might have got this stock at this high price. Rule number 1 of investing that I am trying to follow is that never buy a stock when it's all-time high, no matter how good the valuation is, no matter how good the management is, no matter how good the overall fundamentally the stock is. Never try to buy that at an all-time high price level because the chances of correction is very huge. Point number 2 is people who might have got it at this level when the stock was corrected by almost 20%. They also are in heavy losses. So do not rush to buy a stock that is falling massively. There are few things that we need to do. So point number 1 is you need to really look at the last 1 year's stock price history because it is going to tell you a lot about that particular stock. So for example, in this case, if you look at the history, you will see that in the last 1 year, stock has gained 54% even after accommodating this 35% of correction, right? However, this is not really a true picture because if I talk about this stock's IPO, the stock's IPO came in the month of March and the issue price of the stock was 142 rupees only. Right now, the stock is trading at around 348 rupees level, which is almost 150% up, right? Even from a listing price perspective, the stock got listed at 265. It is still up by around 30-35% from the listing price perspective. Just imagine anchor investors who applied in this particular stock at the time of IPO are still sitting at 150% profit. And what are they likely to do? They might do some profit booking at this point in time. So we really need to be cautious in stocks like this. Now comes the point number 2 that we need to do is analyze what is the reason for this fall. If we understand the reason for the fall, we know what is going to be the future possibility of this particular stock. So let me walk you through that. Now there could be 2 reasons for a stock to massively fall. Number 1 is the fundamental reason and number 2 is the sentimental reason. And in this video, I'll try to give you examples for both of them, right? So let's talk about the Hexacom Telesystems and try to find out what is the reason. Have a look at my screen and you will see that Q1 2025, their results has been really bad. The revenues has been around 252 crores, which is down year-on-year basis from 264 crores. And more importantly, from Q4 perspective, they are heavily down from 300 crore to 252 crores. And even if you look at the profits, it's the exactly same story. Look at the total orders received. In Q1, they have received total orders of 159 crore versus the previous quarter when they received 278 crores of orders. What does it tell you? It tells you that the order flows for this company has also massively reduced in Q1, and that tells me that the demand is slowing down in this particular stock. So we can clearly see that there is a fundamental reason for the stock to come down because of the decline in the revenues, decline in the profitability. Now comes the natural question, why is it happening? And if you look at the sector in which it is operating, which is the EV chargers, there are headwinds in this particular sector. Go ahead and read this. And the company is giving reasons such as the FAME 2 subsidy that was there for the auto companies has been withdrawn. Now many people will not even understand it, so I highly appreciate you to understand these nuances. Then only you can make informed decisions when it comes to investing. Second reason is the demand of the cars in Q1 has been slowed down. Another reason is the sluggish demand coming from the bus segment. So there are fundamental reasons that we can see that the stock is particularly down right now. And this massive correction has brought down the PE ratio, PB ratio, PEG ratio to very good levels. If you look at this, PE is trading at 50 versus industry PE of 59. PB is trading at 6.62 versus 9.47 industry PB, and the PEG ratio is also looking very low, 1.44. I explained the importance of PEG ratio in my previous video. If you have not yet watched it, go ahead and watch it. You're going to learn a lot about PEG ratio as well. Now Rahul, this could be the short-term pain. Absolutely. What is the future outlook of this stock? That is what also we need to do. Point number 3, have a look at my screen. You will see that what management is commenting is that overall, if you see, the EV charger business is likely to grow domestically as well as global basis. And if you you see, for example, electric buses in the global atmosphere is likely to grow at a 40 to 50% CAGR. If you look at the domestic EV charger business here, for example, bus charging is likely to grow 80 to 85%. Even if I become conservative and say that these numbers are highly bloated, even if this sector grows by half of these projections, that itself is a good growth of around 20%, 25% on a yearly basis. So the future outlook of this particular sector is looking very, very good. There is no problem, but there is a short-term problem right now. All this is fine, Rahul. Tell us whether we should take an entry into this particular stock. I can't give you a recommendation, but let me give you a quick technical analysis of this particular stock. So have a look at my screen and you will see three important points. Point number one is that the stock is still up from its listing price. So the stock got listed at around 264 rupees level, and still if I draw it from here, it is still up by 35%. So there is already a good rally that the stock has given. Point number one. Point number two, if you see the two averages, technical averages, this white line that you see is a 50 days SMA, which is simple moving average, and the stock is well below that, which is a bearish signal. Point number two is that the yellow line that you see here is a 100 days SMA, which is again the stock is trading below 100 days SMA. It's a bearish signal. If you look at the volumes down here, again this trading view application is an excellent application if you know how to use it. If you look at the net volume of this company, you will see that the volumes in the last 3 to 4 months has been very, very flat. There is no buying interest in this particular stock. So in my view, it is likely to remain bearish. It might consolidate from here on to the sideways, or it might in fact fall a bit more, because I think right now technically this is looking very, very bearish. So what should we do in such stocks is wait for some recovery to happen. Do not just buy a falling knife here. Wait for some recovery to happen. So for example, let's say if the stock is up by 10%, whenever that happens, at that time you know that the stock has made a bottom and the chances of it growing further is slightly better, and you must do analysis at that time as well, and only buy a stock when it has shown some signs of recovery. Don't just buy a falling knife. Now you might say that, Rahul, why have you included this particular stock in your video? It's a very simple reason. I am not here to give you buy or sell recommendation. I'm here to tell you how to go about analyzing stocks that have seen massive correction, because I really don't want you to catch a falling knife and make losses in your portfolio. This is the intent with which I have included this particular stock. I'll give you another examples of the stock as well, but if you like this analysis, hit the like button. Let me know in the comments a simple thank you. It will motivate me to do some good analysis for you at zero cost. With that, let's move to stock number 2, and the stock is Granules India Limited. Have a look at my screen and you will see that in the last 2 or 3 days, the stock has come down massively from all-time high of 718 rupees to almost right now at 555 rupees level, giving a correction of almost 23%. Rahul, the stock has fallen by 22%. Should we take an entry at this point in time? Allow me 2 to 3 minutes of commentary and you are going to learn about that stock and you can make your own decision. See, the first point I ask you to do is whenever a stock is falling, go back and look at the last 1 year of stock history. Have a look at my screen. You will see that the stock after this 23% correction is still up by 68% in the last 1 year. What does it mean? That before this correction, stock would have given almost 100% of rally, and that is a massive rally. And just imagine the investors who are sitting on 100% gain in the last 1 year. What are they likely to do? They are likely to book profit and exit the stock. They do not want this 68% to come down to 50%. So there is going to be a sentimental driver here, which is fear of losing the profits. Therefore, the stock might see some more pressure. And this is what the last 1 year history is telling us. In fact, the day it crashed by around 16%, I created a post on my YouTube member community giving people timely information about why the stock has fallen and my perspective on this particular stock. And if you want to get these timely updates on a daily basis, consider subscribing to my YouTube member community. I post on a daily basis in-depth analysis of stocks, mutual funds and various other assets, because I spend more than 5 to 6 hours on a daily basis in the stock market. I really don't have any paid courses right now. The only way I teach people is by posting on a daily basis on my YouTube member community. The feedback has been very good. Just go to my channel and press on join button if you want to get these timely updates and want to learn about investing in the right way. Now, coming back to why the stock has fallen is the second thing we need to analyze. And if you look at my screen, you will see that there has been 6 observations issued by US FDA while doing inspection for Granules India Limited. So every pharma company in India that is producing pharma products, they have to undergo inspection by US FDA. And this inspection for Granules India Limited just has concluded on 6th of September, and US FDA issued 6 observations for their factory in Gagillapur. I think it's in Hyderabad. Now you can read these 6 observations on my screen, and they are important for you to read because every pharma company more often than not gets gets these sort of observations. So this is not something unique that has happened to Granules India Limited, but of course this will have an impact on their processes. Now, has this event caused any problems into their revenues or profits? Right now, no, there is no impact. These are just observations. They will continue to produce their products as they have been doing in the last 10 to 20 years. And investors will be divided now because, for example, here Motilal expects still a buying rating on this particular stock, giving a target of 680 rupees per share. Again, this is not my data, not my recommendation. It's out there in the public domain. But one hypercritical point to note here is that their FD business, which is a finished dosage business, that has seen 66% growth, massive growth coming from this segment. What is happening right now is that majority of this is produced by their Gagillapur plant, which is around 26 billion. This is a huge production happening from Gagillapur, and this is the plant where the US FDA has issued these observations. This is a hypercritical point we need to understand if we want to take the bet into this stock, because this may present a huge risk into this particular stock down the line. But overall, if you look at the stock, you will see that Q1 quarter has been excellent quarter in terms of revenue, profitability. Everything is shown positive growth, as you can see on my screen. If you look at the last 5 quarters, the growth has been very flat in terms of the sales as well as profits. So that's another point to consider. But one thing I really like about this company is that in the last few quarters, ROC has been going up. You see the net debt has been coming down. The capex injection has been very good. So I think overall, from a fundamental perspective, if you ask me, the company is looking good. Now, if you look at the valuations of this company, the PE of 27 versus 40 of industry PE. So this correction have brought the PE and PB ratio to a good level. So the PB is also at 4.17 versus 4.50. PEG ratio is 2.39, which is not very high in my view. So what should be our strategy in such stocks? In my view, in such stocks, you need to wait for some recovery to happen. The majority of the damage is done. There might be some more fall, 5%, 2%, 3%, or the stock might move to the sideways. So really need to wait for some recovery to happen and do not just buy the stock just because it is fallen by 23%. Again, not a stock recommendation. I've given you a lot of information, a lot of analysis for you to make decisions as per your portfolio. With that, hit the like button if you like this analysis before I move to stock number 3. Let's move to stock number 3, and the stock number 3 is Cochin Shipyard Limited. Have a look at my screen. The stock has come down from 2900 all-time high of 2900 levels to almost 1800 level right now, giving a massive correction of around 40%. Now, if you look at our point number 1, which is the last 1 year stock price history, very quickly you will see that the stock has gained 228% even if I remove this correction. So the stock has given massive rally, and at some point in time the profit booking is likely to happen. Now, is there a fundamental reason for this stock to fall, or is there a sentimental reason? Let me give you 2 to 3 minutes of commentary on that. So if you look at the profit and loss account of this company, you will very quickly note that the company is sitting at all-time high revenues, all-time high profits. So fundamentally, I don't think there is a problem. If you look at the quarterly results in the Q1 of 2025, the revenue has been very down. But please understand, when you're analyzing a shipping company, you can't really look at quarter by quarter basis, because what happens is that in a particular quarter, if they deliver a ship or collect more money, then it will look very bloated figures or a down figure depending on what has happened in that particular quarter. So can't really take the quarterly view. But in order to analyze the fundamentals of such company, what we need to look at is the order book. If you look at the order book of this company as of Q1 2023, 1 year back, you will see that the order book was around 22,000 crores. If I look at the order book right now in Q1 of 2025, when I'm recording this video, still the order book is 22,000 crores. It means there has not been a massive decline in the order book of this company, meaning that there is a good visibility that was there a year back in terms of the revenue and profitability that is still there. So I don't think there is a big fundamental red flag right now in this particular stock. In my view, it is a purely sentimental reason, because if I look at the CPSE, which is the public sector ETF, which is down by almost 4% in the last 1 month. Also, if I talk about the defense sector within the PSU, have a look at my screen. One of the index fund that is by Motilal Oswal, not a recommendation here, but since the time it has been launched in the month of July, it is down by almost 10%. When an index is down by 10%, you can very well gauge that the sentimentals are not in the right place for the defense sector right now. So in my view, it is purely a sentimental play. Now, because of this massive correction, what has happened to the valuations of this company? If you look at the PE, it has come down to 54 versus 76 of industry PE. The PB also has come down. But when it comes to Cochin Shipyard, in my view, the PEG ratio is very high. It is at 4.80. So still a very high valuation from a PEG ratio perspective, from an earnings growth perspective. If I look at the technical indicators of this particular stock, it is trading well below the 50-day SMA, which is the white line or the gray line line you see. It is also trading well below 100 days SMA, which is the yellow line. So it is in the highly bearish mode right now technically. And given a lot of action that is likely to happen this week when I'm recording this video because of the US Fed rate, because of what is happening in Bank of Japan, what is happening to the FII's flow, I think it is better to wait in such stocks to take entry, because right now the stock has not shown any signs of recovery. And in my view, whenever you're buying a stock that has shown massive correction, first look for signs of recovery, because otherwise you might end up catching a falling knife. So I've spoken about 3 stocks in this video. None of these stocks are recommendation. I would highly request you to go and do some more analysis. Let me know in the comments any other stocks you would like me to analyze. And you can also consider subscribing to my YouTube member community. You are going to learn a lot and it will help you improve your investing on a daily basis. With that, I hope you enjoyed this video. I'll see you in my next video. Until then, keep rocking.